Yes, it is important to keep things as simple as possible, but they shouldn't be simpler than that. There is still some complexity involved in trying to figure out where crypto prices might go. It's important to figure out how it's the best way to measure the momentum in Bitcoin, to measure the growth in crypto. And in this video, we're trying to follow the simple approaches, but we're also looking at what approaches are possibly too simple. Because here's the thing, you've probably seen a chart like this or a variation thereof. This is the Bitcoin rainbow chart, and interestingly enough, the tops tend to align somewhat nicely, the bottoms as well, and it gives us an idea where we might be in the grander scheme of things. Are we currently cheap or expensive? But I'd like to make the argument that an approach like this is probably too simplistic. And here's why. This is actually not the original version of this model. This here instead is. And it shows us how we are, relatively speaking, much more depressed now, and how we could potentially reach all the way up to more than 700K in the short term. This is of course not very realistic. Or have a look at this, the Bitcoin logarithmic growth curve. This has now completely broken down. We are below the trend. The problem really is, just because something has grown in the past doesn't mean that it has to continue to grow at similar rates in the future. And just because something has recently sold off doesn't have to mean that it will recover again. That's always the argument by the bears for Bitcoin, for example, right? Whenever we are in a bear market, people say that Bitcoin is dead, that Bitcoin will never recover. And that's why so few people actually have the guts to buy the bottom. The problem I have with charts like this is also that it doesn't use all the data that we have available for crypto. Crypto is 100% transparent. We can look at the sellers and we can look at the buyers. We can see how much Bitcoin has already moved, how much Bitcoin is very actively traded, what's dormant. And that kind of data helps us much better to determine bottoms and tops. Because I think the crypto market works very much with reference prices. As in, if you're currently in the losses with your Bitcoin position, but you believe in Bitcoin very long term, you're simply just going to continue holding the asset. You're not going to sell if you don't have to. That then means that the selling pressure tends to go down whenever the net unrealized profit and loss is in the negatives. Whenever people are in net unrealized losses, that's when there's no more sales. And the exact opposite happens when people are strongly in net unrealized gains. When the entire market is more than 80% in gains, and of course those gains do get realized at some point, and that then drives losses for the people that don't sell on time. So we tend to just oscillate between euphoria and capitulation, euphoria and capitulation. And it also gives us a nice idea where we are currently standing. Since Bitcoin hit roughly 70K, the net unrealized profit actually went down. So we went from 70K all the way above 100K. The price continued rising, but the net unrealized profit did not. So people realized profit along the way. This is a sign of a healthy bull market. This is a sign that the current price appreciation is not ahead of market growth. People are taking profit. The reason why we see these massive bear markets is always because people that just enter the space get spooked. As in, if they buy into Bitcoin and they don't have much experience yet, and then their investment drops by 20 or 30%, some people that aren't really used to the volatility might just panic sell. Now, if the price doesn't drop that much that quickly anymore, then the bull market can simply continue. And that's currently what we see. Only once we get close to the euphoria greed zone again, it might make sense to under-allocate towards crypto again. Right now, the market is still quickly expanding. Here's another metric I like to look at. I like to look at what are the diamond hands doing. So let's say the Bitcoin whales that normally don't touch their Bitcoin. When they suddenly start moving their Bitcoin, very likely to sell it, that's also when I try to sell some, right? When the diamond hands turn into paper hands, this is a sign worth noticing. And the value days destroyed metric shows exactly that. Whenever this peaks, it means that the people that usually do not sell their Bitcoin, they suddenly start moving it. And while this is not perfect to time the exact top, it's definitely a good time to at least take some profit. It peaked at around 60K in 2021, then it peaked again at around 70K last year. And all the price appreciation that we have seen since then did not yet move the Bitcoin whales to sell their positions. Again, another bullish sign. Here's a slightly different version of the same thing. This is the supply adjusted coin days destroyed. So we're not looking at US dollar values. We are looking at Bitcoin, and this peaks a bit more often. We are adjusting for how much supply is currently circulating. And again, the long-term holders sold quite a bit at around 70K, but now the selling is more muted and it keeps the current bull market alive. Fundamentally, the shorter our time horizon is, the more it becomes a player versus player game. The more it's all about trying to buy low and sell high and hope that we can estimate this better than the other people that are actively trading. If we expand our time horizon, we get less and less into player versus player, but we are betting more and more on the long-term adoption. Thus, if we want to increase the probability that we make money with crypto, we simply just have to expand our time horizon and bet on the assets that long-term tend to still stay around. With Bitcoin, that's relatively certain. With Ethereum and Solana, probably as well. With the smaller altcoins, it's of course less certain. So small altcoins should be traded much more actively than Bitcoin. For Bitcoin, we can just wait it out. We can simply just wait for the adoption to continue to grow. Have a look at this. This is the realized cap hodl waves. Shorter time periods are in red, longer time periods are in green and blue. This spikes whenever the Bitcoin price tends to be very high. So the Bitcoin price being here this line in orange. What this means is that there's most trading activity, most capital moving among the short-term holders when the price is elevated. And this tends to go down when the price is low. In other words, it makes sense to sell when the short-term money is dominating the market. That's when we want to get out. And we want to buy when attention is low, when only the people that are really deep in the space still continue purchasing. And again, the market today is not as hot compared to when we were at 70K in Bitcoin. Yes, there is more short-term speculation compared to when Bitcoin was just at 16K, but we are not yet at the elevated levels that are worrisome. We can also have a look at the inverse. So instead of looking at the trading activity, we're looking at the holding activity. So that's not the realized cap hodl waves, but it's the simple hodl waves. And here is the reason why Bitcoin tends to go up over time. If we remove all of the short-term trading here, we just look at the long-term holding. This tends to go up over time. Have a look at the Bitcoin that hasn't moved for at least 5 years. This is now roughly 1/3 of the entire supply. So this is going up faster than Bitcoin mining is. Over time, the Bitcoin that can be openly traded on the market tends to shrink. And we've got a liquid growing market with a shrinking supply, while at the same time, the amount of fiat currency tends to expand. And of course, the price has to appreciate over time. The ratio of fiat currency relative to circulating Bitcoin is going up, and so the price is going up. Do not forget that the amount of US dollars that are circulating is expanding on average by 6.8%. That's the annual growth. In 1959, we had a total US M2 money supply of 286 billion. This moved all the way to 22 trillion. That's 77 times the supply in the span of just 66 years. So again, 6.8% growth. This is really how quickly money devalues over time. Yes, consumer goods do not go up that quickly in price, but that's simply because consumer goods get easier and easier to produce, right? There is efficiency improvements over time, and that's why things don't tend to get expensive as quickly. Imagine the monetary base was completely stable and the fiat currency base would not expand over time. With the years, we should actually see things becoming cheaper because, again, there is technological progress. Things are simply easier to produce. Machines are automating more and more steps in the value creation process. And so that productivity improvement masks how quickly money is actually devaluing. We will have at least 6.8% annual growth in the price of Bitcoin. But it's likely going to be much more because Bitcoin becomes less and less liquid over time. By the way, the price growth of the S&P 500 is roughly 7% over that time period. There is some supply growth for Bitcoin as well, right? The 0.85% per annum. But again, more Bitcoin gets lost or at least locked away for a very, very long time, bringing it out of the circulating supply. So really, there are two approaches to navigate this market. The first approach is to try to mitigate risk, as in try to find some kind of indicators that show us whether or not we are expensive or cheap, and tend to sell when we are high, tend to buy when we are low, and kind of minimize the over volatility this way. This is important if our net worth is already relatively high compared to our income. So let's say our net worth is 3, 4, 5 years of our income, then we cannot really accept that our net worth drops by 70 or 80%, right? We don't want to go, say, from 5 years of net worth to only 1 year of net worth. But if our net worth is only a few months, then we can digest that volatility. And then we don't even have to time the market. We can just dollar cost average into the asset. It works a little bit like with a mortgage, right? The idea is that a house will appreciate in value, at least measured in US dollars, because the US dollar devalues faster than the house does. And so since US dollar prices of houses tend to go up, it's okay to take on a lot of debt. It's okay to take on that mortgage. It's kind of like a savings plan. We put in money towards that asset every single month. And the only reason we can do this for property is because property keeps its value. And the question is, will Bitcoin keep its value? Will the network continue to grow? And while the number of addresses with at least one Bitcoin is not growing anymore in the last 2 to 3 years, that's not necessarily a reason for concern. Because Bitcoin, since that growth stopped, still went up in price by 5 to 6x. And why did it go up? It went up because of Wall Street. So here is the number of BTC that's held by the Bitcoin ETF. This tends to go up. So there's more and more purchases from traditional finance of Bitcoin. And that segment of the market tends to just accumulate. There's only very brief periods where we actually see this balance coming down. And then on top of that, we've got the Bitcoin treasury companies that do the exact same, right? They're just buying. So the reason why the Bitcoin price is going up is because the people that are currently buying Bitcoin, they tend to never sell. So the market doesn't really heat up that much. The market just sees continued growth as long as those two market segments continue to stack sats. We used to see all the growth from the retail investor. This is not the case anymore. Now we see the growth from Wall Street. And so that's a fundamental reason why we can simply just buy into Bitcoin long term. And especially when the net worth isn't yet that large, we can just continue contributing, say, to an ETF or maybe even to self-custodied Bitcoin. It all works very similarly to contributing to a 401k, for example. Just with the difference that it's much more effective because Bitcoin tends to grow faster. Imagine you would have bought $1,000 worth of Bitcoin every single month for more than one cycle. So let's say the last 6 years. That should be the minimum time horizon you should have with such a plan. If you did that, you had contributed this straight line over here, right? The dollars invested. The worth of your investment is shown here in orange. The Bitcoin price for reference is the line in green at the top. But imagine that after 6 years, you put in 74K, $1,000 every month, but you're ending up with 358K. With a somewhat modest contribution after a reasonable time frame. By now you would own 3.2 Bitcoin. And yes, there is volatility in this strategy. And yes, you might do this. And after 2 or 3 years, you're just at the exact same value where you started, especially after a bear market. But the nice thing about dollar cost averaging is that you're also buying Bitcoin for the very cheap during a bear market. So the psychology here works very nicely. When we're dollar cost averaging in and the price is going up, we are happy because we make paper gains, we are in profit. But when we are going down and we're dollar cost averaging, we can still tell ourselves a good story. Yes, we are temporarily in losses, but since our time horizon is very long, since our time horizon is 5 or 6 years, we are now buying the cheap Bitcoin that has much more upside potential, that can do the multiple X return. So when things are going down, we just say, hey, things are now cheap. It's great. We want to hold this anyway. This is exactly why we are dollar cost averaging. And those are the kinds of returns that are realistic, where we do not have to find the next 10x meme coin. We can just work a bit more, have a side hustle, save that money every single month, and have a somewhat predictable outcome. Of course, as we increase the time horizon or we increase the investment amounts, this is even more impressive. But let's keep it realistic for the majority of the people here watching. Now, here's the problem with investing in this market. There's in general 2 major forces that impact the prices. On the one hand, we've got the macro environment. Where is Bitcoin, Ethereum, and Solana going? Then on the other hand, we've got whatever happens idiosyncratically to a specific altcoin. Now, the problem is most people can't make constant gains because most people aren't really segregating among those 2 influences. So if you're just riding the macro environment, you can just go with Bitcoin, right? You can buy whenever the current price is below the realized price. Whenever we are below the average cost basis of the market is historically the best time to buy. Of course, currently we are very far away from that. But in general, approaches like this work quite well to time the macro. Or we can even go a bit more complex. We can use things like the CBBI indicator, an indicator that aggregates all kinds of other models. And it also shows us pretty well when we are potentially expensive or potentially cheap in the market. The reason why those indicators are great for macro timing is because it tells us how much we should potentially be invested in crypto. We should have very high allocation over here, maybe 30, 40, potentially even 50% of our entire net worth in crypto. And we should have the exact opposite when we are up here, right? Maybe only 5 to 10% of our net worth in crypto. So we can always adjust based on models like this, and we can play the macro. And for the macro, we can just go with Bitcoin because Bitcoin tends to outperform most altcoins most of the time. So that's one approach to make money in crypto long term. And I think that's the most straightforward, easiest approach for people that just start out with everything. But then there's also the approach of higher risk, higher reward, of using the altcoins. But this is now the Bitcoin price that we see at the top. What we now see at the bottom, that's the altcoin market cap. And just have a look at how similar those lines look. When Bitcoin is going down, the altcoins go with it. So even if you take the best altcoin on the market, even if you figure out that the fundamentals of project A, B, and C are the best and that they are doing long-term better than the rest, if Bitcoin goes down, if Ethereum goes down, then the best altcoins go down with it. And that's the problem. There are times when everything is going up and there are times when most things come down. And it seems like the asset selection doesn't matter as much compared to timing the macro environment. But then again, we are back to just trading Bitcoin. If you want to just get macro exposure, we just might as well buy Bitcoin, buy and sell Bitcoin. So really, we want to find a way to bet on an altcoin without the macro environment. We want to neutralize the macro environment, and we just want to bet on the outperformance or the underperformance of a certain altcoin. I'd make the argument that it's actually easier to bet on the underperformance of an altcoin. Because have a look at the altcoins in the last year. Bitcoin, of course, in the last year almost doubled, and the vast majority of altcoins underperformed that, right? We've got 1, 2, 3 altcoins that did similar to Bitcoin, maybe a bit better, but the vast majority did worse than Bitcoin in the last year. And for some altcoins, that happens rather consistently. This is balancer relative to the others market cap. So how is the balancer token, a decentralized finance protocol token, doing relative to all other cryptocurrencies? And it's going down consistently. Now, the reason why this is going down is fundamentally driven, as in there's more and more tokens that hit the market over time. There's a high token inflation, or the tokenomics are not that good. Here is the balancer tokenomics over time. We started out with 20 million tokens, and now that went up all the way to 70 million tokens. And that then has this long-term underperformance as a consequence. And so I like to take advantage of market inefficiencies like this. I like to bet on falling prices of balancer relative to, for example, Bitcoin. Because then we can turn around this chart. This chart turns into this chart here. This is now Bitcoin relative to balancer. So we bet on rising prices of Bitcoin and on falling prices of balancer at the same time. And we get this return curve over the years. So in the last 12 months, this went up by 186%. It actually did outperform buying and holding Bitcoin. And that's better than any straight altcoin pick over here, right? Among the small risky alts. None of them did that performance in the last year. And I also like how constant that performance is. Compare this with the Bitcoin price, right? Bitcoin during that time did go down by 77% at one point, right? The drop from 70K all the way to 16K. This relative ratio did not have those fluctuations. Here is the logarithmic scale, and the maximum drop from top to bottom was 50%. So we are appreciating faster than buying and holding Bitcoin, and we do this with less fluctuation over time. It's a better risk to reward. That's what we all should be aiming for. More return with less volatility. I'm following this kind of strategy already for 4 years roughly. Had I just dollar cost average into Bitcoin, I would have gotten the return indicated by the gray line. But because I also bet on relative valuations, on things like balancer going down over time, I got the return indicated here as the black line. I understand it's not as straightforward as just buying an altcoin. There's a bit more complexity to it, but that's why I created dedicated videos on this. And I want to make this as easy as possible. So here's the idea. You simply watch 2 videos over here that explains the entire strategy, how to execute a relative valuation trade. Once you've watched those 2 videos, I will send you my favorite trade. So that favorite trade is very similar to the balancer token trade. It's going long Bitcoin, Ethereum or Solana, and it's going short the altcoin that tends to go down over time. Here are the 2 videos. It's using perpetual futures to bet on relative valuations, and it's risk management with relative valuation bets. In total, it's roughly 1 hour worth of content. So just watch those 2 videos, and afterwards, after you've joined the community, I will send you my favorite trade that performs very similarly to this chart here. And so here's the offer. If you do not make any money with that trade after holding it for only 1 month, then I'll refund you the membership fee, no questions asked. So simply just send me a message. I will just refund you the $125 per month. If you do make money, of course, with that trade, then feel free to just continue copy trading me. Because I will not just share this one trade, I will of course share every trade that I do myself as well. A link to Premium should pop up directly here on the screen. Just click on that. It will lead you to the website. If it's your very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in Premium. Cheers.